Okay, we've done the groundwork. We've acquired all of the necessary tools that would allow us to solve a simple but complete accounting exercise. Our goal in the next lessons will be to create a balance sheet and an income statement for a very small business. The exercise that we will carry out is simple and easy, but it will be very useful as we will go through a complete series of business operations and will translate them in financial statements. We will be able to practice the concepts that we've learned so far, and I hope that you'll be positively surprised by your current progress. Our task is to create accounting entries and financial statements for a business that was founded by two friends. Their idea is to open a lemonade stand in order to make some extra money during the summer. We will imagine that they have registered a company and use it for this business, and they need to organize the financial information in order to produce a balance sheet and an income statement. Transaction by transaction, we will write all necessary entries in the daybook and create the respective T accounts. We will create all of the journal entries and T accounts in Microsoft Excel. Now, I know that accountants don't do that because they use specific software applications, but Microsoft Excel will be much simpler to follow. Even if you don't know how to use it, don't worry, because everything will be easy to understand. You can find the Excel file that we are going to use in the course materials section for this lesson. At this point, I recommend that you download the pre-solutions version and we will go from there. So, here is our file. Let's take a look at how it's organized. As you can see, it has 4 sheets: Daybook, T accounts, Income statement, and Balance sheet. Imagine that these are pieces of white paper. This is how we are going to use them. We won't apply any complicated Excel formulas. The first sheet will contain daybook entries. In the second sheet, we will draw the respective T accounts. And in the third and fourth sheets, we will have our complete financial statements. The first thing that most business owners do when they start a new business is to commit equity capital to the new enterprise. In our case, the two friends receive some help from their parents and are able to start with an equity capital of $3,000, $1,500 each. So let's register our first 2 entries. The firm received $3,000 in cash, and its equity capital increased by $3,000. First, I will write the 2 entries in the daybook. The date of the transaction is the 1st of June, 2015. The accounts that were influenced are cash and equity. Cash is an asset and stands on the left side of the balance sheet. Hence, when we increase it, we debit the account. Debit means left, right? We'll have a debit of $3,000. Equity, on the other hand, stands on the right side of a balance sheet, and therefore when it increases, we credit its account. Okay, perfect. You can see how the double entry principle functions. The value of debits matches the value of credits, as it should. Let's go to the next sheet and write these entries as T accounts. As you can see, the balance sheet itself is one big T account. On its left side are assets, and on its right side are liabilities. It is very intuitive to remember that when an asset is increased, we write it to the left, and when a liability or equity is increased, we write it to the right. Given that assets stand to the left and liabilities and equity stand to the right. I'll have to draw a small T account on the asset side. I'll name it Cash. Okay, let's use the copy function in order to create a similar T account on the right side. I'll change the name of the account to Equity. Very good. So, as we saw earlier, we need to debit the cash account, given that cash increases and it is an asset. Then we need to credit the equity account. Perfect. You can see that the two entries balance each other. We have $3,000 on the asset side and $3,000 on the liabilities and equity side. The accounting equation is satisfied. After establishing the firm and committing equity capital, the two friends start looking for a lemonade stand that they can buy and start their business with. They don't want to go through all the trouble of buying wood, paint, a wagon for transportation, and the rest of the equipment that is necessary. They want a complete solution, and that's why they started looking on the market and found that someone sells all the necessary equipment for $1,000. They decided to pay $1,000 and buy the lemonade stand. The date of the transaction is the 10th of June, 2015. Let's name the account of the equipment that they bought as Property, Plant, and Equipment. So, the firm buys property, plant, and equipment for $1,000 and pays in cash. Two accounts that will be affected in this transaction are property, plant, and equipment and cash. Both of them are on the asset side. Given that the firm bought a new lemonade stand, its property, plant, and equipment account increases. Since it is an asset, we need to debit the account with $1,000. The firm pays in cash, which is an asset as well. Therefore, we need to credit the cash account and show that it decreased. The two entries balance each other. Let's go to the next sheet and register the transaction in the respective T accounts. I'll copy the cash T account and paste it below. We need to change its title to Property, Plant, and Equipment. Okay, excellent. Now I can debit the Property, Plant, and Equipment T account by $1,000 and credit the cash account with $1,000. By now, we know well that when an asset increases, we write the increase on the left side of its T account, and that when an asset decreases, we write the decrease on the right side of the T account. The next thing that the two friends have to do in order to start their business is to acquire raw materials. These are the products that will be necessary for the production of lemonade. The two friends bought raw materials for $500 on the 12th of June. They made an agreement to pay $250 now and $250 in 2 weeks. We need to register this transaction in the daybook. The firm acquired an asset, raw materials, worth $500. When we have an asset increase, we debit its account. So our first journal entry will be raw materials debited for $500. Then we need to register how the asset was paid for. Two accounts will be affected. The firm paid for 50% of the raw materials in cash, and the remaining 50% will be paid in the future. Here, things get a little trickier. We need to credit the cash account for $250. Then we need to register the amount that has to be paid in the future as a new account that will be called trade payables. It is something that we owe, a liability. The amount that we owe increases by $250, and we know that when a liability increases, we need to credit it. Okay, very good. Let's go to our T accounts and register the 3 entries. We need to create 2 new T accounts, one for raw materials on the asset side and another for trade payables on the liabilities side. Raw materials increase by $500. As we already said, raw materials have to be debited because they are an asset and because they increase by $500. I will write $500 on the left side of their T account. Then we need to credit trade payables and cash with $250, as we already did in the daybook. These 2 entries balance our balance sheet, as we registered $500 on the debit side and $500 on the credit side. At this point, the firm is ready to make some money. The two friends open their lemonade stand and start selling lemonade. We'll take a look at how these transactions influence the balance sheet and the income statement in our next video. Thanks for watching.